let's go back to 22 for a second. You know,
Yep.
how because that was an energy shock. Now, the one thing I'd say about that is, remember, NGDP was growing at 10% plus. You know, that inflation was ripping through. People had savings. You know, right now it feels like maybe the consumer's been 4 years now of these like price resets, which some people had stocks and stuff did great. The people who didn't, you know, I think it's getting long in the tooth. And then you have the K-shaped economy thing that's been accelerated by AI. You know, I just think about it like it's so easy to be negative. So how do you like go through that and be like, hey, you know, in '08, some of the consumer names bottomed well before the market did, right? Because it's easy in these scenarios of high energy prices, weak consumer, weak financials to be very negative. Like, what do you look for, I guess, when you think about shopping rather than just maybe the market capitulating, just from a consumer stock standpoint?
I'm looking for stuff that's been beaten down already, and I'm looking for stocks that are just kind of holding their uptrend, not doing great, but just not absolutely collapsing. You know, a Target over a Walmart, for instance. The Target is at 13 times sales. No one expects earnings to be worth a shit this year, and they're right. They won't be, but there's enough low-hanging fruit there that this was not going to be a huge year for them anyway. It's going to be harder to justify a high multiple in these, especially more discretionary names, than it is to work a longer term turnaround. So, you know, for the most part, Walmart needs a pretty robust consumer at 35%. Like if their comps turn negative through no real fault of their own, it's going to be a problem. They sell a lot of gas. They sell to a deep discount customer, so they can probably offset it. But I'm just looking for, you know, right now you play it according to the book. You look at Casey's General Stores, you look at I think the dollar stores are buy on the dip, and you just kind of steer clear. Nike reports next week. I can't think of a damn reason on earth that I would want to be long that other than everyone hates it and it's at 52-week lows, but that's not enough for me here. You know, because it's just going to be execution doesn't really matter. If you look at, you know, names like the shoe names, I mean, Deck had a nice pop and that just kind of fizzled a little bit. You know, you're not going to get a ton of follow through. And again, it's a time to do less, which people don't like to hear on shows like this. It's always great to come on and have 50 great trades. But if you look at the great traders, they typically are doing a lot less. The truth is that if you're a perma anything, you're probably not going to optimize your returns, but being a perma bear has historically been the crappiest of all the bets. And so I'm trying to find names that no one really expects stuff from and looking for dips on them. Companies that I like would be like an IMAX. I was looking at Callaway Golf today. It's a simple fundamental story. Our old friends, they finally got Topgolf out of there. They're focusing on actual golf clubs. Is that going to be a great business? No, but taking share that is just an axe fight between TaylorMade, Titleist, and Callaway all the time for market share. I think Callaway can take market share if they're able to get their new product. I love the fact that they're actually making golf clubs as opposed to running restaurant driving ranges. That, as we've talked about for the last year and a half, has been the switch you made. The stock has had a decent run, but I love that coming back. I like IMAX here for that matter. You know, I think people are underrating the resiliency of movies in general. You know, not AMC, for God's sake, get out of that. But the only answer for the theater industry is going to be better theaters and a better viewing experience, because, you know, there is no substitute for going to a movie. It's just in terms of at the premium end. So IMAX is sort of well positioned. That stock has been on a screamer. Come back to me. I'm looking for, you know, my wish list includes names that I want to come back to me and cheaper plays that kind of work for the longer term, a mix of you know, just that kind of basket. And so fundamental stories, again, that are going to be a little more resilient, a little more kind of, even in a bad market, people will go to the movies if you have a big IMAX experience, and they continue to kind of benefit from that build out from the dying chains. The truth is, as chains go, I don't want to be long the movie theaters, but I kind of like the IMAX story. So, you know, I'm getting interested in names like that are a little obscure, out of favor. They can come back to me, and, you know, those are the type of things that you get 30% discounts on at the capitulatory ends of these moves, and you can make a dump truck full of money. I mean, think of Victoria's Secrets last year into Liberation Day. That stock started the year at 40, went to 14, and ended the year.
I actually bought that.
40.
Remember, I bought that 15, 16. You know, everyone's like, what the hell are you doing? And I was like, look, when you have these dislocations, buying the garbage is exactly what we want. All right, there we go.
Yeah, there's Bob.
Morning, Bob.
Morning.
How are we doing today?
I didn't see we were starting early this morning.
Yeah, that's okay. We were just talking about consumer, which you know, we were talking a little bit about energy because now our boy Bob, who is a bit of a no one wanted to talk about energy for the first 2 years, the Wall Street beats. Now he's like our hottest guy. So, let's finish off, Jeff, with basically you came on my other podcast and we talked about how in November the consumer was left for dead, and basically we were buying deck and I bought Target, and it was easy to hate that stuff, and they both had nice runs and they're hanging in here. So, I think that's just instructive of like, don't get too negative, and like, also be aware of what's going on. Like, can they cut margins? Can AI help them? I think that's probably for the consumer, one of the things that you really want to focus on is like how much cost savings, how much inventory management, these kind of things can be saved that can overrun, what Bob's going to talk about in a second, which is energy running us all over right now.
Right. And that's going to really kind of what Bob's going to talk about, I assume, is going to expedite the rate of change there. Target, we mentioned them before, and I don't want to mention them as the only stock, but they have kind of the lowest hanging fruit. Walmart's been doing it all along. Amazon's been doing it all along. You have essentially automated supply chain at this point, and you're just turning your stores into distribution centers with minimal touches by actual employees. Because, where is that kind of AI robotics type of thing working already? Restocking shelves, getting stuff from Amazon point A to point B. You can order a product and no one touches it between the last person on the assembly line to the guy who drops on your front porch. And, that's a pretty remarkable sort of situation for them in terms of distribution. And that's going to speed up.